Okay, let's talk about something we've all dreamt about, right? Timing the market. You know, that golden idea of swooping in at the absolute bottom and cashing out at the very peak. It sounds like the perfect plan, but as we're about to see, it's a really, really tough game to play. And it can be incredibly costly. And you know, this quote from the legendary John Bogle just hits the nail on the head. He's saying the biggest thing holding you back isn't your lack of fancy software or some secret knowledge. Nope. The biggest obstacle standing between you and your investment goals is probably your own emotions. So let's really dig into that.
All right, so first up, let's acknowledge the dream, because let's be honest, it's a powerful one.
I mean, it's the first thing anyone ever tells you about investing, isn't it? Just buy low and sell high. It sounds so simple, so obvious. But that little phrase is hiding a huge assumption that you actually know when the low points and high points are going to happen. And this image just captures that disconnect perfectly. This is the dream versus the reality. We all imagine ourselves being the cool, calm investor, buying when everyone else is scared and selling when they're greedy. But the reality? For most of us, our own feelings of panic and euphoria make us do the exact opposite. And that leads us right to the main villain of this story, the emotional trap. And the biggest threat to your portfolio? It's not the economy, it's not a market crash. It's the trap we set for ourselves. See, emotion is like this invisible enemy working against you. It's that feeling of FOMO, the fear of missing out, that tempts you to buy when prices are skyrocketing. And it's that gut-wrenching panic that makes you sell everything when prices are falling, locking in your losses for good.
Now, take a look at this. This is literally the emotional roller coaster of investing laid bare. On the left, you've got the textbook cycle, optimism turns to excitement, then euphoria at the peak. And on the way down, denial, fear, panic, and finally selling at the bottom. And if you think that's just some academic theory, look at the chart on the right. It's the exact same emotional pattern mapped onto the real-world price of Bitcoin. This isn't theory, it's just how we're wired.
So let's break down those key stages, because recognizing them is half the battle. You start with euphoria. That's the, I'm a genius, this is easy phase. Then comes denial, when the market dips and you tell yourself, it's fine, it'll bounce right back. Then fear sets in as the losses get real. And finally, capitulation. That's the moment you just can't take the pain anymore and you sell everything, often right before the market turns around. Okay, so we've talked about the psychology of it all. But what's the actual real-world damage here? What does this cost you in dollars and cents? Let's get into the harsh reality of the numbers.
I mean, it's one thing to say, don't buy high and sell low. We all know that. But just how bad is it really? The data here might actually shock you.
So a study from JP Morgan looked at a full 20 years of the S&P 500, and they asked a very simple question. What happens if you were invested the whole time, but you somehow missed just the 10 best days? Not 10 weeks, not 10 months, just 10 single days out of 2 decades. The result is staggering. It cuts your total return in half. Gone. Just think about that for a second. Half of your potential gains wiped out by being on the sidelines for just 10 days. What this tells us is that the market's best gains happen in these short, totally unpredictable bursts. And when you try to time a market, you're far more likely to miss these explosive days than you are to dodge the bad ones. And look, this isn't just a one-off study. For decades, a firm called Dalbar Inc. has been tracking this. And year after year, they find this massive gap between how the market actually performs and the returns that the average investor really gets. Just look at this data. Over a 20-year period, the S&P 500 market returns somewhere between 9 and 10% a year. Awesome. But the average investor, they only made about 4 to 5%. So where did the other half of the money go? It wasn't eaten up by fees. This study concludes it's almost entirely because of bad timing decisions, getting scared out of the market and jumping back in too late. So why on earth do we keep falling for this? Well, it comes down to how our brains are wired. These are real, documented behavioral biases. There's loss aversion, where the pain of losing $1 feels twice as bad as the joy of gaining one. There's the herd effect, where we just follow what the crowd is doing, even if they're running off a cliff. And, of course, there's overconfidence, where we all think we're the special one who can outsmart the market. Okay, I know this all sounds a little bleak, but there is a solution. And the good news is it's surprisingly simple. It just requires you to shift your focus away from timing and toward your single greatest ally in this whole process. And here it is. This is the moral of the entire story today. If you remember one thing, make it this.
time in the market is more important than timing the market. It's not about being a genius. It's not about predicting the future. It's about patience. It's about consistency. It's about simply being there.
So let's just quickly recap the big takeaways here. First, predicting the market is pretty much impossible. Second, the market's best days are completely unpredictable, and missing them will destroy your returns. Third, our own emotions are our worst enemy. They cause us to act at the absolute worst times. And finally, a strategy of simply staying invested consistently is going to beat a strategy of guessing every time. This is why things like dollar cost averaging are so powerful. They take your emotions completely out of the equation. So ultimately, this reframes the entire challenge of investing. We need to stop asking, when is the right time to invest? The much more powerful question is, for how long am I willing to stay invested? It's such a simple shift in perspective, but it's a shift that can make all the difference for your financial future.